Hey guys, hopefully everyone's doing well. I wanted to discuss today some of the options between a conventional mortgage and an FHA mortgage. Very simple, but again, we eat, sleep, and drink this, and it's very new to you. So a conventional mortgage it's really the ultimate goal where you would like to be for your financing, if at all possible. Nothing wrong with an FHA loan, and there's many pros, to say the least. But a conventional loan certainly is the end all be all goal, if at all possible. So a conventional loan is a loan that requires as little as 3% down. You put as much down as you like. You can put 10, 20, 30, 40, 50, 80% down. Do whatever you would like. And is a loan that is risk based by Fannie Mae. So they're going to look at the lowest credit score of both borrowers. So if borrower one has a 700 credit score and borrower two has an 800 credit score, everything is going to be based upon the score of 700 because that's the lowest middle score of both clients. They're going to look at your debt to income ratios, meaning they're going to look at your income versus any expenses that you have per your credit report, and then including the new mortgage and taxes and insurance, and if there's an association fee, and if there's private mortgage insurance, things like that. So you add that payment for your mortgage, and then any liabilities and those payments from your credit report, car payments, student loans, things like that, and add them together and then weigh them against your gross monthly income. That's what we call a debt ratio. It's called your total debt ratio, your back end ratio. On a conventional loan, that cannot exceed 50% of your gross monthly income. Ideally, it's in the 40 to 45% range, but probably can go as high as 49% and some change. They're also going to look at your down payment. So are you putting 3% down? Are you putting 5% down? What have you? If you put less than 20% down, there's a need to address private mortgage insurance. I'll get into in a further video what PMI really is. But how are you going to address that private mortgage insurance? Is it built into the rate? Is it paid monthly? Things like that. If you put 20% or more down, there is no need for PMI. If you put less than 20% down on a conventional loan, the PMI will automatically go away when you have 22% equity. When you're buying your home, you only need to put 20% down or have 20% equity. But when you're looking to have it automatically waived or terminated, you must have 22% equity. So your interest rate is going to be based upon the lowest credit score. It's going to be based upon the percentage that you're putting down. It's going to be based upon what type of a property is it. Is it a single family home? Is it a condo? Is it a primary residence? Is it a second home? Is it an investment property? All of that, all those factors come into play when you're pricing your interest rate on a conventional loan. That's the way to go. That's what it's all about. And I look forward to speaking with you soon. Talk to you on the next video with what is an FHA loan and then what is PMI as well. Thanks, guys.